Today's topic is portfolio rebalancing. It's early October 2011 and the stock market has been falling mightily of late. In fact, on an intraday basis recently, we hit official bear market territory, which by definition is a 20% drop for the major averages from their recent peak. Now, what happens? How do people feel when they look at their account statements and they're losing money every month since March? Well, I would suspect, it's been my experience, that that's how they're feeling. But what about that old saying that we all should buy stocks when they're low and sell stocks when they're high? Problem with that, folks, is obvious. It's this. This guy is not in the mood, I promise you, to be buying stocks at these levels, okay? Just because of all the bad news, Europe, etc. But what if he had a strategy? What if he had a discipline that he was committed to that actually forced him to do that? Well, there is one, and we call it strategic asset allocation. I'm going to give you an example. Let's say that we have a person, late 40s, maybe 50, been sticking money in his or her 401k for a few years, has a nice sum, and has always bought into that notion that everybody told him, and that was that we should always, when we're younger, own stocks because that's going to give you the best rate of return long term. Of course, keywords being long term. So he buys that idea or that notion and puts 60% of the portfolio in stocks or equities and 40% into fixed income, which would be your bonds and CDs and money market. Okay. Well, strategic asset allocation would actually force a rebalancing periodically back to that mix. So the example I use is every 6 months. So let's say we start here, and 6 months later we're here. And let's assume, so I can do the math, that we break even on the fixed income portion. So consequently, we had 150,000, 60% of 250 in the stock market. It lost 20%. We'll get to the Dow Jones Industrial Average. That'll be our proxy. So in the market, the portfolio correlates perfectly with that. So now this is down 20. So now we're at 20%. So now we're at 120,000 in equities, and we're still at 100 in fixed income. So consequently, 6 months after we begin this strategy, our 250,000 becomes 220,000, and we're probably not feeling real good about our statement when we get it. Okay, but the strategy now forces us to rebalance back to the target allocation, which would mean actually buy more stocks and sell the fixed income to get it back. And obviously there'd be several $1,000s of purchasing that we need to do at a 20% lower than we started place in the stock market. Okay, so let's say it's 2008 and the market goes down another 20% for that 6 months. Now the 120,000 becomes 196,000, and this guy is thinking, get me out of there. The strategy is telling him to buy. When everybody else is gloomy, the world's coming to an end, we gotta buy if we employ this strategy. So we buy back to the 60% and essentially continue to accumulate more and more equities at a lower and lower price. Okay, folks, this is critical to long-term success. Here's why. Because as the market's falling, again, we are keeping that allocation consistent. The market will inevitably bounce. Nobody can actually tell you exactly where, when, or by how much. Some will try. They'll be wrong 90% of the time. So we don't want to follow any market timing strategies. We want to follow a rebalancing strategy, which again forces us to buy as things are lower. So now, let's assume we have a 2009 style bounce, and now the market in 6 months goes up 20%. Well, because we reallocated on the way down, now we'd be over allocated to stocks, and we'd actually take some off the table. Okay, so on the way up, let's say the Dow was at 12,000 when we began. Because we continue to buy lower, what ultimately happens is as we go up and we rebalance on the way up, all things being equal, we actually get back to our 250,000 at a lower level on the Dow than the 12,000 where it sat when we began. And then over time, as we grow above that, then we are constantly selling stocks and bringing our concentration down back to the 60. Therefore, when the inevitable reverse comes, we don't have as much stocks in the portfolio as we would if we just left it alone and let it grow, which some people even advocate that. So I'm a firm believer in long-term buy and hold investing with this rebalancing element. This keeps the portfolio's volatility consistent with its original intent and puts us in a position, particularly in down markets, to be able to bounce out of that faster and then had we not done the rebalancing. So essentially, folks, the whole purpose is to do what the greatest investors in the world have always said to do. And by the way, the greatest ones would tell you never try to time the market, but have a discipline that keeps you buying when stocks are falling and selling when stocks are rising. And this is a very good one. Thanks for watching.